Do you know what it takes to transition into retirement successfully? There's a handful of things that you want to make sure you think about when it comes to the financial plan, the investment strategy, our withdrawal strategy, taxation, and your health. We talk about all of these throughout this episode. You're going to want to listen all the way through. Thanks for joining. We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in. Welcome back to Secure Your Retirement. We are glad that you are tuning in with us today. We've got an episode that's going to go in a lot of different places today by design, and it's all around transitioning into retirement with peace of mind. If you've been listening to us for a while, there's a handful of topics that we cover. Retirement and creating a successful retirement is not easy, and we definitely don't want to hope or guess as to all the different elements and the decisions that we have to make, which is why we've designed this whole concept called the peace of mind pathway. I'm going to tell you more about that towards the end of the episode, but for the episode today, I have alongside me Nick Hymanson. He's another certified financial planner on the team. He's been with the firm for several years and works very closely with our clients. So he gets a lot of different experiences, different situations thrown at him. But at the end of the day, a successful retirement plan comes down to a handful of things that really need to be thought about well and decisions that need to be made in a timely manner, as well as encompassing this concept of a retirement focused financial plan. So Nick, thanks for being here.
Absolutely. Happy to be here.
All right, so let's open this up and just kind of talk. The goal here in the next 20 minutes or so is to walk through a handful of things that we look at as we're helping someone think through what the retirement's going to look like, transition into retirement, and then obviously enjoy retirement. So let's take the first topic here, Nick, because, for a long time we work, we save, and whatever goes into the 401k, at the end of the day, we receive a paycheck after benefits are taken out of that paycheck, taxes, 401k savings are taken out, and then we get some money in the bank, and we learn to kind of live within that, and it just comes regularly. Every other week, in most cases, we're getting money coming in the door, and we're checking all the boxes of savings, so we're not too worried or concerned about where the money is coming from as long as we're working. What we know naturally happens is as we approach retirement and we get into retirement, there's this shift in thinking that becomes sometimes anxiety inducing if we haven't thought through it well enough, which is, whoa, wait a second. I was earning and there's a company that was paying me, or my business was providing my income, and now I've retired and that's not there anymore. So now it's all about what have I done to prepare for retirement and how am I going to recreate this paycheck, which can be a little bit nerve wracking if we haven't thought it through, or if we've delayed thinking about it. So Nick, start us off and just help us understand, in your experience sitting with clients, walking through strategy, and this phrase of now your investments now have to become that paycheck. What are your thoughts there?
Yeah, so I can 100% say that it is nerve-wracking for many people, and transitioning from working for so many years to actually spending what you've saved is an emotional hurdle for many people, and it's just something that you've never done before. We've never done before. So it is something that we talk about a lot with our clients. It gets back to having a financial plan and why it's so important, not only before retirement, but transitioning into it in terms of knowing where income's going to come from, the best places to take it, and basically how to strategize and structure that income to make sure we're doing it in the best way possible. So we've talked about this a few times in past videos, and the way we look at a structured income plan is ultimately utilizing three different buckets. The first bucket is really the cash bucket that we talk about, and really the reason for that cash bucket is more short-term money. That's money that for many people, you can call it your emergency fund, but that's money that we like to keep aside as a savings or a buffer in our plan at all times. The second bucket is the market bucket. So that's going to be really long-term money. That's really for market growth, and there is going to be associated risks there with investing in the stock market. And then the third bucket, which really gets into how we structure and how we can rely on a certain bucket for stable income, is getting into that safety income bucket. That's the third bucket, and that helps us really to protect against downside risk, but it also provides a good rate of return. The goal is better than essentially money markets right now, but no risk. So we're avoiding the risk of downside and the risk of really having to rely on that money during a down year, but also having that money available for the, we like to say, we can say medium term. So over the next year, there's money in there and going forward so that we're not relying on a bad market year and not being stuck in that situation. So
Right. I like that. So, picture for a second, you've got money in a safe place like Nick was talking about that's going to earn a decent rate of return, not exposed to market risk, and that's where we're drawing our money off of. And then we now have our growth bucket or our market money that's got longer term growth, and the only way it gets longer term growth is because we're not really needing to tap into it as often. Because we've got separation of our monies. They're doing different things for us at different times and creating cash flow without the worry of the market crumbling, which we feel like, there's a threat of that happening every other week. So Nick, one thing that does come up in our world, and it's a concept or a risk that we talk about, which is sequence of returns risk. Can you, in a nutshell, just explain what that is and why this strategy kind of alleviates a lot of that risk?
yeah, so what sequence of returns risk is ultimately the risk that right after you retire and start withdrawing on your funds, the stock market or returns in general have a bad run of many years where they could be down. So think of years or time periods like the early 2000s, really 2007 to 2009, even 2018 to 2020 when there was some longer term volatility in the market. These are all years where if you retire right before those years, there could be significant negative effects of your long term plan. And so the safety bucket really helps to protect against those risks. If we can basically tie away some of the money or at least allocate it to a place that can't be down, that allows for us to rely on that money going forward, and there's no risk of that money going down. So the longevity is longer if compared to if you were drawing on those funds as accounts are going down in years like the early 2000s, 2007 to 2009, times like that.
Yeah, there's been so many studies done on this concept of sequence of returns risk, and every single one of them pretty much comes back and says you want to try to find ways to avoid it. So, this system of having a safety bucket and a growth bucket does a really good job of alleviating that risk. You can't get rid of it altogether, but we can do a pretty good job of minimizing it pretty significantly. So, when we are drawing on our money, right, we're creating our own paycheck now, and that paycheck has to last the next 20, 30, 40 years. Uh, Naturally, the next question becomes all around taxation, right? We've done a good job. If we've done a good job of saving, we've amassed some wealth into different types of accounts. Your IRAs that are pre-tax, your Roth IRAs that are tax-free, your taxable accounts that are your brokerage style accounts that you deal with capital gains and interest and dividends that get taxed in a whole different way, and then cash in the bank are kind of the sources. So let's talk about, Nick, some of the, I guess we could call it the hotter strategies that we are definitely talking about with our clients right now. The first being Roth conversions. And I'll just set this up a little bit to say Roth conversions, our opinion is that everyone should look at a Roth conversion, but not everyone, not, it doesn't make sense for everyone to actually do a Roth conversion. To us, this is a year by year conversation that we have in our annual tax strategy meetings with our clients. Some years it makes sense, some years it doesn't, and there's limiting factors that we are definitely going to consider. So Walk us through Roth conversions and why they can be so powerful in long-term tax planning.
Yeah, so ultimately, just to start, what a Roth conversion is taking pre-tax money and then paying taxes on that money to get it ultimately into a Roth IRA. So it goes from IRA, which is pre-tax, to Roth IRA, and then you're paying taxes during that transition, and then it can grow tax-free. So there is ultimately a time period where it takes to get to, so that actually makes sense to do. But when transitioning into retirement, these are the years, especially really between 60 and 70 years old, before required minimum distributions start, where it's incredibly important not to 100% do them, like Mer said, but um, at least analyze what the long-term potential benefits could be. So, for many people, or for let me say this, for some people, it can save hundreds of thousands to more than that by the time they're in their 80s or 90s. For other people, it might not make sense. So it's very situational, and it's based on different scenarios and income and withdrawal strategies. So they're all kind of interconnected. But it can be a very powerful tax strategy, and something that for anyone who is retired, they would definitely want to analyze and make sure that they can strategize around that.
Yeah, the idea of getting money in a tax-free place opens up flexibility. It makes legacy a lot smoother. That transition, if you leave assets behind for them to inherit it tax-free, is always a benefit to them. But we have to make the decision to pay some tax along the way, and does it make sense? That's a big question. Those are things that we try to work through with our clients throughout the planning process. So another one that I think gets overlooked is withholdings. So again, we're creating our own paycheck, right? When we were working and receiving a paycheck, the withholdings or the taxes were kind of taken care of for us. It came right out of the paycheck. Well, a lot of times what people don't realize is you can do the exact same thing in retirement. So Nick, walk us through withholdings, how they work, and how we help people establish what the right amount is.
Yeah, so for many of our clients, we are, and especially if they are retired, we're analyzing their withholdings. We're making sure that, for one, they are avoiding underpayment penalties, which is essentially not withholding enough throughout the year. And at that point, the IRS would tack on some penalties for not paying your taxes on time throughout the year. But also, we're looking at each different account and how it all kind of comes together in terms of what we are withdrawing from, and how it might have a positive effect long term. For one of the examples that we've come across recently is basically during our tax strategy meetings, we're working with some clients who have sold real estate, whether it be we can say it's this year. In that example, for this person, there was not necessarily a need to pay an estimated tax on some of the gains that they made on real estate. So instead of paying that tax or withholding anything from the sale, we've been able to, or we've identified that they were able to keep some of those proceeds in the bank, earning a little bit of interest, so that we can analyze that, and when those taxes are due, we can pay those when they file. So things like that, analyzing withholdings, what we can do with some of that money before either the withdrawal happens or during the year, so we can take the most or we can have the most benefit, is something that we're wanting to look at.
Yeah, and the IRS, the simple way of looking at it is when that taxable transaction happens. So whether that's a withdrawal from an IRA, that's a taxable transaction, or there's a sale of property, like Nick mentioned. When that happens, the IRS expects to get their tax revenue from it when it happens, not later on, not at the end of the year, not at come April tax time. If we wait that long, that's where penalties can come into play. And so getting your withholdings in line is one just simple way to just create a lot of comfort in retirement, knowing that when April comes around and it's time to file your taxes, hopefully we're breaking even and we're not getting a big refund, which means that we paid too much in taxes, and we're not owing a lot, which means we may be exposed to some underpayment penalties. So something big to think through, as simple as it can be, to pay tax, doing it the right way Makes life a lot simpler. Another big strategy that we walk through on the tax side with clients is all around charitable giving strategies. And I'll say this, we could care less one way or the other how charitably inclined our clients are, right? We have plenty of clients that love to give, and they have plenty of reasons for that. We have clients that don't really give, and they kind of just spend their money on their families. Either way is fine, but if we are going to charitably be inclined and give money away, there's ways that we want to do that to make sure we're getting some decent tax benefit out of it as well. So, what are we talking about there with the strategies, Nick?
Yeah, so there are two strategies in particular. The first one is called a qualified charitable distribution, or for short, a QCD. And so what that looks like is ultimately someone has to be at least 70 and a half years old. And at that point, they're able to make direct payments out of their IRA or pre-tax accounts to a charity in order to either cover their RMDs, required distributions when they are of RMD age, or they can get funds at least paid to the charity of their choice in a tax-free manner from an account that's never been taxed. So that's one of the strategies. And then the other strategy is called a donor advised fund. So this is for essentially people who are looking to benefit from lumping a whole bunch of charitable distributions or a charitable giving together into one year rather than splitting it up between multiple years. If we split it up or if we put it together into one year, in certain circumstances, we can get a higher amount that we can deduct or itemize from our taxes in that one year, which could save tax money significantly over that 2 year period, where you'd normally be paying either checks to the charity or QCDs. Sometimes it does make sense to look at, can we group these charitable distributions together into one year and get a higher tax benefit?
Right. Yeah. Simple numbers there. So let's say you give as a family on a cadence of, let's just say, $10,000 a year to different charities, and it adds up to about 10,000. And maybe that 10,000 that you give is just not enough to overcome this standard deduction to get you in a place where you can itemize. Well, if we're in the standard deduction and we're giving charitably, we actually don't get much benefit from those charitable distributions, because the standard deduction takes a lot off of our income as it is, so you don't get both. But if we're in a place where we can push ourselves into itemization, the only way to do that is we have enough giving or enough expenses to get into itemization. So let's just take someone that gives 10,000 a year, and like Nick was saying, we bunch it. So we triple that or double that. So we say let's put 20,000 or 30,000 or the next 2 or 3 years worth of charitable giving into this donor advised type of a fund, that allows us to now say, hey, technically this year we gave 30,000 to this donor fund, which allows us to grab that as a deduction, which now pushes us into itemization, which could be tremendously beneficial for our tax return. Again, all depends on a handful of different things that you would want a tax focused type of strategist working with you on to make sure it even has benefit to you. But a lot of our clients have seen some good benefit from it. Again, you have to be in this charitably inclined type of manner to take advantage of it. Okay, so let's look at an investment strategy now that also does focus on tax benefits too. It's called direct indexing with tax loss harvesting. Um, and it has gained tremendous popularity over the last 5 years or so. One part of it is because technology has gotten so much better. The other, I think, is just because investors want better strategies and access to them. So we use this strategy for our clients. Nick, take us through, how this works in a nutshell and what type of money we use this with.
Yeah, so very high level, ultimately the money that is utilized to successfully utilize this strategy is non-IRA money, or otherwise known as non-qualified money. So this is money that is taxable when you are selling stock at a gain, and it's also if you're selling stock at a loss, it can qualify as a loss on your tax return as well. So basically, we're working with capital gains in these type of accounts. So the way direct indexing with tax loss harvesting works is we are essentially utilizing not one ETF to directly follow an index, but in this scenario, we're utilizing different stocks. It could be 50 to 100 different stocks to still follow the index. We can call it the S&P 500. So instead of 500 stocks, we're utilizing around 50 to 100. But now, because we're in so many different stocks, if one position is down, we can go and sell one of the losers in that group, realize losses, but then also still buy back different stocks to make sure we're still following the index. So we're essentially following an index, but accumulating losses and growing the account as tax efficiently as possible. Um, so that's ultimately the strategy to get the non-IRA account in a good place that can accumulate losses over time.
Yeah, we had a client that is utilizing this strategy, and basically what it came down to is the account itself earned about what the S&P 500 did for that period of time. So let's just make up a number and say the S&P was up 10%, and her account was up 9.5. So we expect that it's going to kind of mirror the return of the index that we're trying to track. But the funny thing that she said is, how is it possible that I made money and I lost money at the same time, but my account value went up? At the end of the day, that's what tax loss, direct indexing with tax loss harvesting is that we're indexing for the market growth and the index growth, but we're able to strategically generate losses at the same time that's going to benefit us in our tax return in a handful of ways. So it's a cool strategy. If you got more questions around that, we're always happy to chat. All right, let's transition here to, if you worked for a company for a very long time, whether it's through employer stock options, restricted stock units, all these different things, and you get to a place where you're uh, significantly overweight in one company stock. So let's say you worked at IBM for a long time and you got shares and shares and shares over the 30 years that you worked there. All of a sudden, you may have a couple $1 million in IBM stock, and that's now 60, 70, 80% of your worth. Well, that is considered pretty high risk. If a lot of my worth is in one position, my future relies on that company to perform. So getting out of that strategically or utilizing that strategically, those are things that we help people think through as well. So what are a couple of those strategies, Nick, when we are just have a concentrated stock position?
Yeah, so we utilize a few different strategies. Ultimately, it depends on someone's scenario. So basically, what we can do in a certain scenario is we can come up with a strategic plan over a certain amount of years to liquidate that specific stock. And so, some of the reasons why we might be doing that is, like Merce mentioned, there's some high risk there, especially when transitioning into retirement. We want to make sure that the investment strategy is something that's going to last long term and not be subject to a whole significant amount of risk where the plan might actually not work down the road. So that's one strategy, a staggered liquidation. The second strategy, especially getting into retirement, is for people with a large amount of stock or a one stock that's especially highly appreciated or grown a lot over the years, is an option strategy. And so an option strategy can be used to specifically generate income from that stock, and that income you can utilize to live on during retirement. But also, an option strategy can be used to protect against some of the losses if that stock were to go down. So that's another strategy that we can use. Also, a tax strategy, if you're charitably inclined to fund the donor advised fund, like we talked about earlier, it is tax efficient to take a highly appreciated stock and use that to fund into a donor advised fund. What that does and allows is for really no one to have to pay the capital gains tax on that highly appreciated stock. And then the amount that you donate, that market value, is the amount that you can go and utilize to itemize during your tax return.
So we've talked about our thoughts on setting up the investment strategy, which is that bucketing aspect. We've talked about tax strategies. Let's go away from that for a second and let's talk about health. And that's a massive concern, right? The first is running out of money. The second is health issues in retirement. So, Nick, if I've got someone retiring prior to Medicare, which is age 65, what is it that we're talking to them about?
Yeah, so prior to Medicare, there are a few different strategies and things we want to be aware of. So prior to Medicare, there are subsidies that we can utilize or that we can stay and make sure we can qualify for those based on our income. So we're always strategizing with clients, um, whether it be different priorities. So if the priority is to make sure we qualify for a subsidy, um, when we are pre-Medicare, we can utilize different withdrawal strategies, whether that's taking from taxable accounts or using cash in the bank for a few years to make sure that maybe our health insurance pre-Medicare is not, thousands of dollars a month. Maybe it's a few hundred if we keep our income down. That's a strategy. But also pre-Medicare, something to think about is also Roth conversion strategies. And so instead of necessarily prioritizing getting the subsidy, we can also make sure income is utilized to convert at a low tax rate for tax-free growth down the road.
Hmm. It's kind of one of these things in retirement planning. You got to pick what your primary objective is. Like he said, if you want to get the biggest subsidy, we need to keep income low. Someone else may say that no, I want to work on Roth conversions for my legacy, which means we're going to naturally take our income up, which means we may not get some subsidy. So unfortunately, we can't have it all, but we can guide ourselves in a leaning towards what our actual goal and priority is. So take us now into Medicare. I turned 65. What are the things that I need to be thinking about as I'm approaching Medicare age and then into Medicare? And by the way, one thing that's really nice for Nick and I and the advisors on the team is that we know a lot about this. But a few years ago, we were able to hire Sean Southard, who you may have heard on this podcast before. He is our health insurance professional that focuses on pre Medicare and going into Medicare. So he handles a lot of these conversations. But in a nutshell, Nick, what are we really thinking about as we approach Medicare?
Yeah, so from a tax and financial planning perspective, we are looking specifically at Medicare and the potential surcharges on Medicare when it comes to income generation. So the Medicare surcharge is called IRMA, and what that basically is a charge um, that is generated basically for making too much money in retirement, or more than it's about 200,000, and it's been going up over the last few years. So basically, whatever the priority is, getting back to that, whether it is Roth conversions, whether it's keeping income low, or if it's just normal income that's coming in the door, we always want to make sure that we're aware of any Medicare surcharges and that we're making sure we're planning around that. Roth conversion planning gets into a lot about making sure our brackets are in the right spot. We know exactly or close to where the income's going to come out to be so that we're staying under certain brackets, or at least knowing where those Medicare surcharges are going to come into play.
Yeah, and the rules around Medicare and the coverage itself are constantly evolving. A previous episode that we did with Sean Southard, he kind of walked through some of the changes that happened here in 2025 for Medicare prescription drug plans. So if you haven't listened to that one and you are of or approaching Medicare age, you definitely want to check that one out because it will apply. Okay, so the last topic, and I wish we could cover everything, but that would take us hours, is I do want to touch on long-term care because that's a big fear for a lot of people. It's also a lot of people make the statement of, well, it's just so bad in the sense of being able to get coverage. They ignore it or they're worried about talking about it, and we feel like we can't afford it. I will tell you that was very much so a true statement about 5 years ago. I think today, now more than ever, with rates where they are, with insurance companies realizing that a lot of mistakes have been made on certain types of policies, they've come around and created a handful of different ways to make sure that we do cover this gap of long-term care. So, Nick, let's kind of walk through and maybe just give some people the ideas that are out there for long-term care coverage to maybe just relax their fears a little bit and entice the conversation with their advisor or whoever that they work with.
Yeah, so I'm gonna go over, four strategies to think about long-term care. And so the first one is we call self-funding or self-insuring. So the way that looks is essentially based on someone's financial plan. Um, we can utilize assets to basically cover those long-term care expenses down the road. So this is not buying insurance. This is not buying any sort of long-term care or hybrid insurance, which I'm going to get into. This is strictly using your own assets, savings, retirement accounts to pay for long-term care expenses. So that is really going to be based on someone's ability to do that, but also, potentially if they think that they will need long-term care down the road. So there it gets into some personal history, family history on if they think they might need that. So that's number one. Number two is traditional long-term care insurance. That is we can call it annual, semi-annual premium payment type insurance that you pay a certain amount each year and you are covered for a certain amount of long-term care coverage down the road. So that type of insurance was very popular a few decades ago. Right now, a lot of it's really not available or extremely expensive. But if you did buy that traditional long-term care down the road and you're still paying for that, you've definitely seen those premiums go up. But that is one of the strategies that we see as well and advise on. Number three is asset-based long-term care. So the way that looks is essentially utilizing a lump sum of money to fund into an account, not a recurring amount like the traditional, but this is a lump sum that's a one-time payment that's going to provide a certain amount of long-term care down the road, as well as a death benefit if you don't utilize that long-term care benefit. So that's something that's super important as well to think about. And then the fourth one is a hybrid annuity. So there are annuities out there that can provide a long-term care death benefit, but also life insurance as a add-on to the policy. So for someone who can pay for that, can qualify for life insurance as well as long-term care, that's something that we analyze and think about and strategize with our clients as well.
Yeah, long-term care is it's a conversation that no one really likes having, but it's a conversation that needs to be had at the very least to evaluate can we afford to self-insure or do we need to transfer some of that risk? Again, the options are way better today than they ever have been. So I'm going to wrap us up here. And so, we talked about a handful of topics, but there is still other ones out there like estate planning, like beneficiary designations, and, how you're going to live. All these different things really kind of fall in our eyes under this umbrella of what we call the peace of mind pathway. And the peace of mind pathway is constructed of really three major elements or three major phases. The first being what we call the peace of mind roadmap. The roadmap is really what we just started talking to you about, which is we got to get all these things in order, which starts with the retirement focused financial plan that says, hey, here's where we are today. Here's where or when we want to retire, and here's what we want our retirement to look like. What are all the things that we need to think about in between, like Social Security decisions, Medicare decisions, withdrawal strategy, tax strategy, estate planning, Medicare, long term care planning? The list goes on and on. So we create this roadmap or this financial plan that guides us throughout our retirement. The second element of the pathway, once we have that roadmap created and everyone agrees that this is the right path that we want to take, we then go and our team goes into what we call peace of mind implementation, where now we've said a lot of stuff. Now we got to go do it, which is implement those strategies on the investment side, implement those strategies on the tax side and the healthcare and the long-term care side. Let's make sure our estate plan documents are up to date. All of that is implementation. And then the third of the pathway is our peace of mind nurture. So in our office, what we do is two major meetings a year that we curate, that we want to see our clients for, which is a financial planning strategy meeting that's kind of saying, hey, how's this year shaping up for you? Are we retiring this year? What's our withdrawals looking like? Are there big trips that we need to be aware of this year for cash flow, right? That's financial planning. Are we selling a property? Are we buying a new car? That's financial planning. The second meeting of the year covers a lot of what we talked about, which is tax strategy. So, does it make sense to do a Roth conversion this year? Are we giving money away? Let's make sure we do it the right way. Let's make sure our withholdings are in line, right? All these things to make our tax life a little bit better, short term and long term. And so that's what nurture is that we spend all this time building out this roadmap. We spend all this time in implementing it. But what inherently happens is that we do want to make some changes along the way, and that's why we have to continue to nurture that plan. And every time there is a change or that is made in the plan, well, now we go back and now we reassess the roadmap. We re-implement changes that need to be made, and then we continue to nurture year over year. What I can honestly tell you is that I've never seen a plan that was built and didn't have changes to it along the way, or didn't have things come up that created roadblocks, good or bad. And so that's why we believe the pathway, in a nutshell, kind of covers all the bases for a successful retirement that I know everyone is looking for. So, Nick, thank you so much for hopping on and kind of walking everyone through some of the things that we're thinking about as we help people think through and live through and have a successful retirement. Thanks for your time.
Thank you. Happy to be here.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.